The risk of ours is very low. I would put our risk in the 1 to 3 category on your scale.
Are you tired of hype and high risk trades? Then you'll love this interview. My guest has built his career on selling puts the smart and conservative way, focusing on steady returns, not big gambles. Today, we're digging into how he does it and why it works. Welcome, Lee Lowell.
Hi, John. Great to be here. Thank you.
Great to have you. Please give us the 40-second version of how you sell puts and why this works for you.
Well, number one, we love selling put options. In my opinion, I think it's probably the greatest option trading strategy ever. But the way that we do it, the way I teach people to sell put options in a very conservative manner, we use very deep out of the money strike prices. I have the stocks here, we're selling put options way down here. And that's a good way for beginner put option sellers to dip a toe into the strategy. So we're very conservative. We sell deep out of the money strikes. And you get smaller premiums for that, but it's done for a reason because we want to have a lot of cushion for directional error. You know, a lot of people are not very good at picking stock direction. So if you can give yourself a lot of cushion for directional error, selling out of the money conservative put options can work very well for the beginning trader. And once they understand the strategy a little better, once they get a little bit better at reading chart direction, then they could up their game and get a little bit more risky with the strikes that they choose.
Before we dig into it, tell us a little bit about yourself.
I've been around over 30 years in this business. I started out in the New York commodity pits on the NYMEX exchange. That's in New York City, trading energy options and futures, specifically crude oil, natural gas, unleaded gasoline, heating oil, stuff like that. I worked for a small company based out of Chicago in these New York pits and did that for a number of years. And after that, kind of moved off floor, took myself out to Hawaii to start learning internet trading behind the screens like we do now. Most people just click their mouse and buy or sell. So I learned how to do that, learned how to read charts, and been doing that a long time. Made the conversion over to stock options, the U.S. markets, because there's thousands and thousands of stocks to choose from. In the commodity world, there's only maybe a handful of good commodities to trade on. I do that for a living, trade for myself. I run some newsletters all about put selling. I have my book that I've written, if you can see over my shoulder here, and the 4 main strategies that I think are great for any beginning options trader. And that's been taking me over the span of about 30 years. I love what I do. I love trading. I love teaching people. And that's where I stand today.
You know, when I prepared for this interview, I asked ChatGPT to analyze your YouTube channel, and ChatGPT came with a conclusion. He is essentially the Warren Buffett of retail put selling. Is that a fair description?
Wow, I didn't even real I mean, I know you can ask Chat GPT a lot of questions, but that one's a good one. I guess that's great company to be compared to Warren Buffett. I have been selling puts for a long time. I do teach a lot of people how to sell put options. So I'll take that as a compliment being compared to Warren Buffett. But that is my bread and butter. That is my number one strategy. I think it works very well. I think for anybody that wants to step into the options trading world, learning how to sell conservative put options gives them good coverage of not having to worry about getting the direction of the stock right all the time. You know, when you sell a put option, you're really obligating yourself to potentially buy a stock at a certain price, and you get to choose that strike or that price of that stock. So you're really in control as a put option seller. You're getting to choose the stock that you want to trade. You're getting to choose the potential level where you get to buy that stock, and someone's going to pay you money up front for that obligation. I think it's a win-win for everybody.
How would you describe your trading philosophy?
For me, first and foremost, it's all about looking at the stock charts. If I had to describe how I trade, I you need to be, at least in my opinion, you have to have somewhat knowledge of technical analysis, which is chart reading. It's all good and well to know the fundamental analysis. You know, what's the stock or the company's PE ratio? How's their earnings and revenue? I mean, all that information is out there. Everybody knows it. But if you learn how to read charts and you learn how to follow the trends, that's the most important thing, I think, with success in options trading. And even, as I said, if you're not getting the direction so right all the time, you can still be a successful options seller, specifically a put option seller. So my philosophy is have a rudimentary understanding of how to read stock charts and then move into the game of selling put options, and you'll do pretty well. I mean, that's the way I've been doing it for a long time, and it has served me well too.
So let's dig into how you trade, but let's take the basic question first. What does it actually mean to sell a put?
Obviously in the options market, there's two kinds of options, call options and put options. We concentrate on put options, and there's two players, a buyer and a seller. If someone who buys a put option, they're expecting the stock price to go down. And they're basically either speculating, they're thinking, this stock is way too high. I think it's going to drop. I want to buy a put option. The other person on the other side of that trade is the put option seller. And when you sell a put option contract to the put option buyer, you get the money up front because they have to pay you for that option. So you collect their premium just like an insurance company, collect the premium, and then it's all based on where the stock goes. When you sell a put option, what you're basically doing is you're obligating yourself to potentially sometime in the future buy shares of that stock from the put option buyer. And it all depends on what you're looking for. If there's a stock that's at $100 a share and you really like that stock and you say, you know what, I want to get long or bullish on this stock. It's at 100. That's a little bit too expensive for me. I'd rather buy it at $80 a share. You sell a put option at 80 strike. And then if the stock falls to 80, you get to buy your shares of stock. And the put option buyer gets to sell their shares of stock. So you got two people playing both sides. And really all it is when you sell a put option, you collect the money up front, and then you're obligating yourself to buy a stock at a certain price. And if the stock falls to that price, you're happy you get to buy that stock. If the stock doesn't fall to your level, you just keep the money, just like an insurance company. They collect the money all the time for something that usually doesn't happen. Same thing with the put option seller. Sell a put, collect the money, and you may or may not end up buying shares of that stock.
But of course, people don't sell puts in the same way. The traders have different rules, and now we will go into your specific rules for selling puts. Let's start with your choice of underlying. How do you choose which underlying you will sell a put on?
Over the years, I've curated a list of stocks, probably about 100 stocks that I look at every single day that I deem would be worthy to sell a put option on. And I've curated this list over the years, going through the S&P 500, going through the NASDAQ 100, going through the Dow Industrial 30 stocks. And I've picked out the top, I'd say 100 out of all those three indexes. And I follow them. As I go through my list every day, I just check the charts. I want to see if the stock's moving up, if it's moving down, if it's moving sideways. So as long as the stock's in an uptrend and having a pullback to some kind of support area within that uptrend, that gives me my signal that, okay, this stock is ready for a potential put sale.
What makes a stock make your list in the first place?
These are name brand household companies that everybody knows about. I'm talking about Apple and Google and Walmart, and there's so many stocks. Even Tesla's in there as well. I like to play Tesla because it's got great premiums to sell options on. We look at Coca-Cola, Pepsi, Nike, all of the brand name, a lot. I mean, everybody knows the companies that we trade on. I'm not using obscure companies. I'm not using penny stocks. These are household brand names, well-known companies that have done over the years. Netflix, Verizon, just multinational companies that everybody knows. And these companies are profitable pretty much. Those are the companies that I'm looking for. I'm not looking for high flyers. I'm not looking for stocks that just launched a month ago. These have to be, at least for me, trading on an exchange for at least 5 years and have a good following, good products that they make. Kind of like Warren Buffett, the company, you have to know the company, you have to know their products, and they have to be a very successful company at the same time. That's pretty much how I make my list.
And you have this list, so take us through the process of picking each week or each day you trade from that.
As I said, I'm scanning through the charts all day long. And once I come across a stock that is certainly in an uptrend, pulling back to some kind of support area, I use either a 20-day, 50-day, or 200-day moving averages. I have all three of those on my charts. So I'm looking on a daily chart to see if a stock's in an uptrend, pulling back to some kind of support area, getting ready to possibly make a bounce. And then that's my cue for, okay, I'm going to start lining up some potential put sell opportunities. We're using strike prices $50 and under. We're not using something like a Netflix, which is over $1,200 US stock price. It's just too expensive to sell a naked put. So we concentrate on strike prices $50 and under, because if we have to buy shares of that stock, it's not a really big stretch for a lot of people. So, like I said, it's all about reading the charts. I'm looking for these uptrends. I'm looking for the pullback to the uptrend, and just go from there.
Sorry for interrupting the interview, but I would like to spend 40 seconds to recommend a fantastic tool for options traders. It is Option Strat. You may have noticed that we use Option Strat often here on Theta Profits. And to be honest, it would be hard for me to do my options trade without Option Strat. I love how I can visualize my trades in Option Strat, see how they will develop over time, and even share my trades with others. There are numerous other functions, such as the options flow, telling where the big money in options trade is flowing right now. This is a recommended tool. Check out the affiliate link in the description.
So you've chosen your underlyings. Describe your entry mechanics for us. DTs, strike price, position size, etc.
One thing I will always say is that in the US markets, each company is required to report their earnings every 3 months. So there's 4 times a year that they report their earnings. So our goal is to always have a position in between those earnings announcements. We don't want to hold the position over an earnings announcement, because the stock could move unexpectedly on us, and we don't want that to happen. So when I find an underlying that I like and I see when the earnings date is, then I'll tee up a put sell trade. And we're typically use our criteria is the stock prices here. We're going at least 20% below that stock price for the strike price. So we've got a 20% directional buffer. We're looking anywhere from 1 to 3 months out in time, as long as that fits within that non-earnings period. And we try to use we're looking for small premiums, or what someone would consider smaller, 25 to 30 cents per contract. That's actually $25, $30 that you'd get in your pocket in a 1 month to 3 month time frame. We typically can close the trade out in about 60 days. And so we use the shortest expiration we can find, where we can get at least 25 to 30 cents per contract and have a 20% buffer. That is a very conservative, I should say extremely conservative way to sell put options. And I do that for a reason. A lot of people are new. They've never sold a put option before. So I want to get them involved in the put selling process in a very conservative manner, safe manner, lots of cushion. And when they're ready to bump up their risk tolerance, they can move themselves up in strike prices. I pick the stock, I provide the initial strike price, and then they can choose which one they want to choose based on their own risk tolerance.
But when you go that far out in the money and you collect 25, 30 cents, what type of annualized return would you get?
Well, that will depend on whether you use a margin account or a cash account. In the US, at least, if you have a cash account, you have to hold aside the full cost of the potential cost of that stock. So if we sell a 50 strike put option, the potential cost would be $5,000 if you're assigned on the shares of stock. If you use a cash account, you always have to hold aside, as collateral, $5,000. And you don't know whether you're going to buy the shares of stock or not. And so for me, it's really not worth it to have a cash account, where we typically use a margin account. And in the States, with those kind of options that we choose, our brokers holding anywhere from 10 to 20% of that 5,000 in order to get into the trade. So most of the options that we sell, if we can make a $25 profit and we have a $1,000 hold on it, that's 2% in 60 days. You annualize that, and it's not so bad. You're probably doing better than the S&P 500, maybe a 14, 16% annualized return. And that's if you're using a margin account. Cash account, your returns are going to be a lot smaller because you have to put up more collateral. So when we sell put options, we use a margin account. And that's not, you're not paying interest to your broker. You're not borrowing any money. This is just some of your own free cash that's kind of being held off limits. That's what's called the margin requirement. So the returns are not that bad, even when we're selling smaller premiums like that. Now, when you start getting into selling higher strike prices or more at the money strikes, then your returns are a lot better if you're still using a margin account. But then your risk is higher because the chance of that stock potentially falling is greater and you may get assigned earlier. And we're not opposed to that. It's just that a lot of my members, they really don't have a lot of interest in buying multiple shares of stocks. They just want to collect the income and move on to the next trade. And that's another reason why we use these deep out of the money strikes, because the chance of assignment is extremely low. The strikes that we pick have roughly about a 95% probability the stock's not going to fall that far. The option decays, theta, as you know, and then we buy the option back a lot cheaper, and then our money gets released. We move on to the next trade.
And then we get to managing the trade. What are your rules there?
The rules is that hopefully we're going to be able to take profits. I mean, if my chart reading skills are good enough, or at least I have some cushion for error, as long as the stock either goes up or kind of stays flat, even falls a little, that option will decay. So we kind of wait, we wait it out. We wait for the option to decay in price. And then when it hits what I call the 80% rule, once that option decays about 80% of its original value, then we look to buy it back. And that's typically at around 5 or 6 cents per contract. We'll buy it back. If we get into trouble, now remember, we're always selling puts on stocks that we would be okay owning if we got assigned, even at that much lower strike price. But if the stock starts to tick down and there's some bad news about the company, but I'm still okay potentially holding for longer periods of time, the risk management in this case is that we will roll the trade. We will roll the trade down and out in time. So we'll buy back the initial put option and we'll sell another put option at a further out expiration at a much lower strike price. So we lower our potential cost basis in that stock. And we've rolled a number of trades over the years, not many, but enough to give us more time in the trade for the stock to kind of turn itself back around and go higher again. So rolling is our best strategy if we get in trouble. And as far as taking profits, we use that 80% rule to lock in our gains.
And you really don't want to get assigned.
Most of our members are not really interested in buying lots of shares of stocks. So we take these deep out of the money strikes where I said the chance of assignment is very low. It's like less than 5%. If we do get assigned, then we'll take the shares and we'll own them. And then we'll start invoking the covered call trades, which is sort of like the wheel trade where you sell puts, you get assigned, and now you start selling covered calls. And hopefully you get called away. The stock will go up, you'll get called away. So the whole position will be closed out. We have 1 or 2 positions right now where we actually had to take ownership of the shares and we've sold some covered calls. And we're just at this point waiting to see what happens, waiting for the stock to turn itself around and go higher again.
What is the worst thing that can happen with this way of trading?
The worst thing that could happen with any bullish strategy, of course, is that the stock or the investment goes down in price below where you've purchased it. And then that's the same with anything. Whether you buy stock, whether you buy calls, whether you sell puts, which are all bullish strategies, is what we do. The worst case is that the stock goes down and it keeps going down and it keeps going down much further than you ever expected. And then the worst case is that you have to close out the trade for a loss. And no one's going to be right 100% of the time. There is no guarantees in investing. There's no guarantees. News could come out at any time. The company, the CEO's cooking the books, the patent failed, or the FDA didn't approve the drug this company was using. So stocks could drop for any number of reasons. And that's the risk you take. You just make sure that you do enough of your own research, feel good about your research, and then you get in the game. If you're never in the game, you're never going to have a chance to make profits. As long as you do your research, that's the best you can hope for.
But when this happens, when will you take the loss? Do you have a rule for that?
We'll roll. And then if we have to roll again, we will. And then I think if the stock just does not look good anymore, I mean, if the news on the company is just really bad and the stock has dropped much further than we ever wanted it to, we will get out and sell. Let a stock, no stock has gone to zero that we've played with. We've taken losses before. Stocks have just gone down further than we would have ever liked after we've taken shares, we've sold covered calls, we've rolled, and it's just not working anymore. Can I give you a specific number on where that is? Not really. It's more based on where the chart is at that time, what kind of news is coming out, and the option prices are changing all the time. So I can't say, well, we always get out when the option doubles or triples or whatever. It's just not something that we've done because we're hoping to hold on to these stocks for long periods of time. These are quality stocks. Could you imagine taking ownership of Apple and then just deciding, you know what, I don't want Apple anymore? I mean, you'd be kicking yourself a couple years down the road that you got rid of it. That's pretty much how I feel about the companies that we get involved with. Most of these companies that we trade with, I'm not willing to let those go for the most part. So I haven't really gotten to that point where, yes, we've taken some losses. I can't even remember the reason why. The stock just wasn't looking good on the charts. And I said, let's just get out and move on. Haven't really looked back since then.
What are the biggest mistakes that you see traders do when it comes to managing risk?
First of all, I think people are a little bit too gung ho. They don't know enough about the strategy. So they'll sell at the money puts on, let's say, Tesla, and for like a 1 week option. They think they're going to get away with these very short-term trades without any issues. And as we know, a stock like Tesla can move $20, $30 in a day. And people that have not dealt with that kind of movement get really surprised at how quickly a position could go underwater and how much money they could potentially lose. So I think people will underestimate how risky options trading can be, especially selling options. People will get their you know what handed to them because they just didn't understand options enough. So I think the biggest risks for most people is that they just don't know how options operated. So I'd say give yourself a little more time to research and study how options trading works before you really jump into things.
I always ask my guests to place their strategy on a risk profile scale from 1 being very low risk and 10 being very high risk. And you can define these numbers as you see fit. What would you say about your way of trading?
The risk of ours is very low. Considering the cushions that we have for these types of trades, I would put our risk in the 1 to 3 category on your scale. Pretty low, especially when we're using great stocks. We've got a lot of cushion for directional error. There is not a lot of risk involved in that perspective. If your philosophy is you got to be in the market for the long run to make the money, if we have to hold on to the shares, we will for the long run. On your scale, I'm down at 2 to 3 at most.
This is a very conservative way of selling puts. What have been the results of trading this strategy over the last years for you?
It's been great. It really has been great. As I said, if you're using a margin account, our returns are roughly, 2% return on 2 to 3% return on margin in a 60-day hold period, which is not that bad. It's definitely better than the S&P 500. When we get the down moves, I mean, think about COVID. Everybody was nervous in COVID. Everybody was very all crazy, up in arms, scared in COVID. When we see massive moves down in the market like that, obviously that's not good for any bullish strategy, even put selling. So we take a step back a little bit. During COVID, we probably had a lot less open positions than we would normally have, only because, as I said, it's all dependent on how the stock and the market looks on the charts. If everything's going down, there's really no sense of sticking your neck out and putting your money on the line when everything's going down, unless you want to sell stock short or buy put options, then that's great. But if you're a bull like I am, I'm definitely a long-term bull. I'm just taking a step back and waiting for things to kind of turn around. Now, the good thing in the States, at least in the last couple of years, interest rates were on the higher end. So you can, on your free cash, earn 4 or 5%. This thing was over 5% for a while. So I just had a lot of my money in cash waiting for the market to turn around. Even in the conservative fashion that we sell put options, when everything's going down, nothing bullish is going to work. So take a step back, let the market do its thing, keep your money safe on the sidelines, earning 4 or 5%, and just wait for things to turn around. That's pretty much my philosophy.
But how exactly do you measure your results as a percentage of the margin used?
That's for me personally, right? Yeah. And I'm selling, outside of our newsletter, I'm selling put options all the time. I sell zero DTE options. I sell put options on the SPX, which is the S&P 500 index. I sell long-term put options on stocks that I'm willing to hold. I run the whole gamut. And, as long as these options keep decaying on me, they'll either expire worthless or I'll buy them back using my own 80% rule. So it has worked well. over the years. Every once in a while, I'll take assignment of some shares and I'll sell covered calls, and hopefully those shares get called away, and then I just start all over.
So let's sum up. Who is this way of trading best suited for, and what are your most important takeaways to share with our viewers?
Number one, I think for anybody that's getting started in the options trading world, most people learn how to buy calls because the market goes up, they're bullish, they want to buy call options. And most people kind of default to buying these out of the money call options, very short time frames, and they end up losing their money because the stock doesn't make the move in the required time. Conversely, selling put options, selling conservative out of the money strikes, you get the cash up front, you got a nice big buffer. It's an easy strategy to people to understand how to trade options. In my opinion, when people come to me and I teach my students, the two biggest strategies we talk about is put selling and buying deep in the money call options, which is another strategy for another day. So anyone who's getting started, think about selling put options.
You trade many strategies. How does this fit in the bigger picture?
Put selling is my number one for sure. If I have an inkling or there's a stock that I'm really gung ho about for the long run that I want to get bullish on, then I will use my deep in the money call option buying strategy where I'll buy at least a 90 delta call option for 6 months to a year, maybe even longer, that I'm willing to give that stock time to develop and work and move its way back higher over time. And when I want to play out very high price stocks, something like a Netflix, which is over $1,200 per share, and I'm bullish on Netflix, I will sell a put option credit spread, typically a $5 wide put option credit spread. And if Netflix goes up, like I hope, or if it just doesn't really go anywhere, then that put credit spread will decay in value and I'll buy it back as well. So it's really, the four strategies in this book behind me. We've got the deep in the money call option buying, put selling, covered calls, which we love to do, and selling put option credit spreads. And that's my whole gig pretty much.
What are good resources for people to learn more about this?
On my website, we have a free ebook all about put selling. It's called Put Selling Basics. You can watch a lot of YouTube videos, make a lot of YouTube videos about put selling. And once again, my book behind me, if you're interested in reading a little bit more.
I will, of course, also recommend to watch some of the other interviews on this channel about a lot of different strategies and ways of trading options. Lee, thank you very much for joining us and sharing your knowledge about selling puts.
Pleasure. I really enjoyed it. Thanks for having me on your show.